Good day, and welcome to the First Property Group plc Preliminary Results Conference Call. Today's conference is being recorded. At this time, I would like to turn the conference over to Mr. Jeremy Barker, Business Development Director. Please go ahead, sir.
Thank you very much. Good morning. Welcome to the First Property Group plc Preliminary Results Conference Call for the year ended 31st of March 2018. If you go to our website and look under the tab Presentations or Media, you'll see a copy of our preliminary results presentation, and that's going to be the basis that I'm using for this conference call. So assuming you're already there, please go straight to page 8, which is a summary of our financial performance. And the first thing that you'll see is that our statutory profit before tax is up 1% to 9.23 million. Our diluted earnings per share was down marginally by about 13%, and the reason for that was due to a deferred tax credit in 2017 of 608,000, whereas we had a deferred tax charge in the current year of 90,000. But in view of these results, the directors have resolved to increase the final dividend by 3p to 1.18, which together with the interim dividend will make a total dividend for the year of 1.6p, which is up 3% on last year. During the year, we did benefit from a favourable FX tailwind, which boosted our profit before tax by 435 grand than if on a constant currency basis. That's at 4.8% higher than last year. Turning to our balance sheet, our net assets per share are up from 34p to 40p. That's a 15% increase, and it's important to note at this point that we carry our assets at the lower of book cost or current market valuation. Hence the next line of our adjusted net assets per share, which is carried according to the EPRA valuation methodology at market value, which are up from 47p to 53p per share. Our cash balances are largely unchanged from last year. And then moving on to the segmental analysis, well, looking at the group properties in particular, which is the majority, is the largest contributor to our earnings. The book value of our group properties is 147 million, and the market value of those is 171 million. The gross debt held against those properties is largely unchanged at 117 million. And our total assets under management are up 31% to 626 million, of which 454 relates to third-party funds under management. And the split there is now 62% in the UK, largely as a result of new purchases on behalf of the new fund that we raised last October, FPRO Offices, and Poland now at 35%, Romania at a small 1.9%. So just summarising the highlights of all that, as already mentioned, it's another record actually for the group profit, even though it's only a small increase on last year. Our total assets under management up 31% to 626 million, and the third-party assets up 45%, and we expect that to continue to grow. The adjusted net assets, that's the net assets held at their market value, less any tax liabilities, is up 11% to 53p, and as already mentioned, the final dividend increased by 2.6%. And we're very pleased and proud to retain once again our top ranking against the MSCI benchmark index for Central Europe, now for the 12 years since we first since 2005, when we first started investing over there. Page 12 is a chart that we're particularly proud of, and it just charts the continued growth in our adjusted net assets, but I've already spoken about that. And likewise, page 13 shows the progressive increase in our dividend, something that we're also very proud of. Throughout the credit crunch years, despite being a leveraged investor, we never once had to raise money from shareholders and we've maintained or increased the dividend throughout that period since 2003. Turning to segmental analysis, starting with the split between the two divisions. We've got our group properties division, which, as mentioned, produces the majority of it's the biggest contributor to our overall results, and then the fast-growing fund management division. And you can see on page 15 the split between the two. 11 million was the contribution to profit before tax from group properties, and 1 million was the contribution from the fund management division. These are both prior to the deduction of unallocated central overheads, PLC costs. And then turning specifically to each division in turn, starting with the fund management division. That 1 million contribution to profit before tax is, prior to the deduction of unallocated central overheads, is 8.2% of our profit before tax, up from 3.4% of our profit before tax from last year. The increase in the third-party funds by 45%, there's always a time lag between the funds going up and the fee income associated with that increase in funds, because the fee income is levied on the duration of the period that we are invested in. When we're buying properties during the year, we're only getting partial year contributions for that fee income. But that fee income is now running at an annualized 2.6 million per annum, and that obviously excludes the contribution from the latest fund that we raised in July of last year, FPROP offices, because the fee arrangement that we arranged on that fund is that we are not charging an annual fee, but instead we are participating in a share of the profits. And because of the purchase costs associated with buying commercial property, which is 6.8% standard purchasers costs, it takes some time to get over that hump before those properties start generating profit. So that we would hope that in the current year, for 2019, there will be a contribution from that fund. And page 17 shows the growth in our net assets. It was, and the explanation for this being fairly flat until 2015 before rising again was that we had an expiry of one of our large fund management contracts in 2015. But it's now very much on an upward trend. Page 18 shows you the split between the various different funds, and page 19 shows you the split between the different investor categories. You'll note that FPROP is about a quarter of the funds under management, and we'll come to that in the group properties, but it does include our majority shareholding in one of the funds that we manage, FPROP Opportunities PLC, where we've been selling down our shares, and we're now a 51.5% shareholder. But because we are not a minority shareholder, we're required to consolidate the earnings of that fund into the earnings of the group, and therefore we account for that fund as though it's a directly owned property. As soon as we sell down to a minority or an associate status, we will be able to deconsolidate, and our third-party assets will correspondingly rise, and we'll be able to recognise fund management fees. Turning to our group properties, contribution was 11.18 million, which was 92%, 91.8% of our profit before tax. The group properties comprise 10 properties, 5 of which are held in this fund I've just been talking about, FPROP Opportunities PLC, and the other 5 of which are 2 office buildings in Warsaw, 1 office building in the north of Poland in the Tri-City area, and a warehouse and an office building in Romania. Turning to page 21, you can see the contribution between the different segments of our group properties. So the large grey bit at the top represents the 5 buildings directly owned by us. The orange bit represents FOP, which we consolidate because we're the majority shareholder, and then the grey bit at the bottom represents our shareholding in 9 of the 12 funds that we manage as a firm. So clearly the contribution from the 10 directly owned properties, including the 5 held by FOP, is the biggest contributor to our results, and the contribution from those 10 properties is set out on page 22. And it's a very steady shift there. The net income, nearly 19 million euros. The interest expense down a bit from last year. The net operating income also slightly down from last year. And after interest, 15.6 million euros. This is all in euros versus 16 million euros last year, generating 3.5 million euros of free cash. And the reason, a slight increase in both the debt amortization. We've reduced our debt by 7.84 million over the last year compared to reducing it by 7.2 million in the previous year. But we also had CapEx of 2.83 million, slightly up from last year, and that mainly relates to the shopping centre at Ostrovich, which is held by FPRO Opportunities plc. So the value of those 10 properties is marginally up from 192 to 195. Very sustainable yield on market value there of 9.6%, and a very manageable LTV in our view because of the high cash being generated level of 69%, and the weighted average unexpired lease term has actually increased by 2 months from last year despite the passage of a year, and despite the increase in the vacancy rate actually. So these 10 group properties are all held in separate special purpose vehicles which are not cross-collateralized, and there is no recourse to the group for the debt secured against these 10 properties. Our current weighted average borrowing cost is 2.34% per annum. If interest rates were to go up by 1%, it would increase our interest rate bill by £610,000 per year. Very manageable in the context of our overall group properties earnings. But we do mitigate our exposure to interest rate rises by the selective use of interest rate caps, and at the year end 49%, and fixes 49% of our bank debt was at a fixed interest rate. The reduction in net operating income I mentioned earlier of 700,000 euros was caused by the sale, firstly, of one of our warehouses in Ploiești, Romania, and so therefore there was obviously no contribution from that, and also the lease expiry of another warehouse in Romania, which we have not fully relet yet. We've relet 40% of it. But then in February 2018, i.e. just before the current year end, we got vacant possession, and this is more material, of a large office building, 10,000 square metres office building, we got vacant possession of 10,000 square metres in Warsaw, Oxford Tower, of a lease that had previously been generating 3 million euros of income a year. We've already relet 26% of it, which will generate 1.21 million euros a year, but that will not come on stream immediately because we've got to spend some money fitting out the space before the new tenants take occupancy, but we're in receipt of good interest for the balance of the 74% that we still need to let up, and we look forward to reporting on that in due course. Turning to the tenants in these 10 properties, the largest is a SECO, and that is a Warsaw Stock Exchange, top 30, Warsaw 30 Stock Exchange listed technology company. First Property Group Poland is the next largest, and that relates to us being a tenant in our own building, Blue Tower in Warsaw, and also putting a lease over some of the space that was previously vacated in Oxford Tower, or Czabińskiego 8, in February of this year. I think the other names should all be familiar to you. with the exception perhaps of the unpronounceable number 6, which is a Polish government agency. And Bank Zachodni WBK is a large Polish bank, and likewise the Miasto number 8 is another Polish government agency. And the LPP number 10 is a large retailer. They actually have a presence now on Oxford Street in London. Turning to the outlook, economic growth in both Poland and Romania continues apace. There's been a change of government in 2015 in Poland to a single-party government, and its rhetoric has been less friendly towards the EU, and they've introduced, or they've mooted various measures, some of which they've rolled back on in the face of opposition from the EU, such as they were seeking to increase the rate of taxation on larger format retailers, and the EU said that that was unfair on the larger format retailers versus the smaller format retailers, and they had the pragmatism to row back from that. Nonetheless, the rhetoric is not wholly investor friendly, but the economic growth continues apace, and we are reasonably sanguine about it all. Commercial property, the market, investor demand remains robust. In fact, office vacancy rates in Warsaw are now down to about 5%, which is the lowest it's been for a long time, or sorry, more like 10%, but they're still down to low levels. They've been in the mid-teens for the last several years. Bank debt, the banking market's operating well in Poland. The typical margin senior bank debt is 2.5% over Euribor, and bearing in mind Euribor is still in negative territory. The all-in costs are manageable, and actually the margin is not too dissimilar to the same types of kind of margins one can find in the UK. Romania, on the other hand, is growing very fast, at faster than 4%. In fact, in 2017 it grew at faster than 5%. But the property market, or the commercial property market, is small still, about €1 billion turned over last year. The rhetoric coming from the government over there is less friendly, and we're finding it harder to find attractive deals to do. But bank margins have actually come in a bit over there. They're now 3.5% to 4%, whereas a couple of years ago they were 4 to 4.5%. And the UK, we're wholly focused on offices in the UK, and the fund that we raised in 2018, we're very confident about the strategy that we're pursuing there, which is to buy older offices where the rents are cheaper than you could find, or basically cheaper than you can build new office property at and rent it out. And so as these properties get converted to residential, the supply is diminishing, and we think rents will rise. Hence our confidence to enter into an arrangement on the FPROP Offices Fund, where we earn a share of the profits rather than a fee. I think at this stage, I've trotted through that fairly quickly, but at this stage, can we open the call up to questions? In the room with me is Ben Habib, the Chief Executive, and George Digby, the Group Finance Director.
Of course. If anyone would like to ask a question at this time, please signal by pressing *1 on your telephone keypad. If you are using a speakerphone, please make sure your mute function is turned off to allow your signal to reach our equipment. A voice prompt on your phone line will indicate when your line is open. Please state your name before posing your question. Again, please press *1 to ask a question. We will pause for just a moment to allow everyone an opportunity to signal for questions. We will now take our first question. Please go ahead, caller. Your line is open.
Stephen Green. I just wanted to know the new mandate for the office property. I was wondering if we have already booked any profit for that, seeing as it's not going to be a fee-based mandate, and it's like a profit based on profit. And I was wondering if we've booked any profit for that, or if that's going to come later on.
This is for FPROP offices, the offices fund you're referring to, is it?
Yes. Is that the new mandate for the UK offices this last year?
Yes, correct. Yeah, you're exactly right. We haven't booked any profit for it so far because as we buy properties in the initial phases of the fund, the cost of stamp duty obliterates the income. So we need a little passage of time to allow the income to defray stamp duty costs. And then the fund becomes profitable and we can start taking a profit share.
Yeah, so it's sort of paid in arrears, as it were, I suppose.
Exactly. Exactly. Yeah.
Yeah. Okay, thank you.
Once again, if you would like to ask a question, please press star 1 on your telephone keypad.
Whilst we're waiting for someone to ask a question, it's worth, I think, going to the Finance Director's report and looking at the record of the company. We've earned the growth in our adjusted net assets, including dividends paid, is over 26% over
Per annum
on an annualized basis. I believe over any 5-year period you care to measure it over from 2006.
Yeah, correct. Yeah.
That's the Finance Director saying correct.
Currently no more telephone questions queued. As a reminder, that's star 1 if you would like to ask a question.
Well, if there's no further questions, thank you very much indeed all for participating. If you want to email me personally, that's fine, jeremy.barkes, B-A-R-K-E-S, @fprop.com. I'd be very happy to answer any questions you may have by email. Thank you very much.
Thank you. This does conclude the First Property Group PLC preliminary results conference call. Thank you for your participation. You may now disconnect.